So it's kind of funny when we go back to when we were just reacting to the chaos and there was a big housing crunch and nobody had a place to live. This is exactly what people were living in. if you can, if you can imagine being in a trailer with horrible insulation at negative 30-degree weather, this is what the government and the companies up here who were hiring people were trying to get people out of. So you fast forward to where oil prices are today, you kind of had this delayed reaction with a lot of the builders who finally got land approved to develop, who finally got infrastructure in, who were able to get their sub base together, their contractors together, and weed out all the bad ones that are up here. We're now in the lower oil price range, and we're starting to see some of that inventory coming online. It's causing a little bit of rent compression, but again, we have such high yields here that the margin of safety, more than anything else, is so high up here that we weren't chasing the yield, we were chasing margin of safety. So while some people bought because they were more offense driven, meaning they were looking for the higher returns and just something to complement the portfolio with the higher cash flows, we were looking more for we were coming from a defensive posture, meaning, okay, if our assumptions are wrong or something happens to the market, which we now have seen where we've landed with the lower prices, how do our investments fare with a different climate? And we're still at double-digit returns on cash. So it's a very safe market, and again, we're at the bottom of the third inning in a 9-inning game still. So now we're actually looking at properties like this. So we're catching up, we're getting people out of skid shacks, out of man camps, out of RVs. We're putting families into houses like this. We are managing those houses for a lot of our investors. So we're in the trenches, we kind of keep an eye on what's happening to rents. Now, that particular property right now, a year ago with $100 barrel oil prices would have rented for maybe $3,200 per month, $3,000 per month. We're right now at about $2,500, $2,400 per month for that same exact 3-bedroom, 2.5 bath, 2-car garage. This particular one actually has a lease of $2,850 per month, and you want to be careful not to have anybody leasing your property that's in what we call an upstream company. Upstream companies are the ones that felt a lot of pain recently because when you lay down, you go from 180 some rigs down to 70 some rigs. Anybody who works on those pads or around those pads or indirectly for companies that work in those pads has felt the biggest impact in the lower oil prices. So even though we're not going anywhere and all these companies have pretty much rooted themselves in that market, we're seeing definitely some income compression. We're seeing some overtime going away. But that has a lot to do with those upstream companies. Your midstream companies, however, the ones that service all of those wells indirectly, meaning infrastructure, roads, pipeline, oil transportation and storage, all of those infrastructure type jobs, those are very strong right now. So for example, one of our tenants works for a gas company. They had legislation in 2013 that said once you have so much flare, you burn off so much of this gas, this natural gas that's a byproduct of the drilling, you've got to eventually cap those flares and capture that gas. So a lot of those companies are doing extremely well. So if we didn't drill one well, we still have, if we didn't drill one more well going forward, we just took everything down, we still are 2 to 3 years behind on just infrastructure to service the existing 12 to 13 active gas and oil wells in the area. And to kind of put that into perspective, what you have going on up here right now accounts for about 1.2 million barrels a day in production. In Texas, you have about 3 times that. So between Texas and North Dakota, that's half of America's oil production. So again, with the innovations and efficiencies in drilling, we're in a market at the very beginning of the game here. It's not a boom, it's an industry, but we have to adapt to the volatility of oil because make no mistake, this is not a diversified market. We are in the energy sector. We just happen to be doing profiting off of the energy sector in the context of real estate. So it's kind of like those during the gold rush, the people who made all the money were the ones selling the shovels, not the ones mining for gold, but the ones selling the shovels, even though they're in the shovel business, they're really hinging off of the gold mining business. And we're in the same boat. So we're here to stay. It's going to be long term. We have to adapt and make sure that we're investing in properties where there's a big margin of safety. So let's talk about the climate today. This is as of September 2nd of 2015. We still have, if you look at the core counties, and we happen to be in the epicenter of the play in Williston, North Dakota, also in Watford City. In those, we're in 2 of the 4 core counties where the wells are the most prolific, they're the most profitable, and we have the lowest break-even point. Hence, the reason that in those 4 core counties, we have over 90% of all the active wells in western North Dakota. And that translates as far as the economy goes, and employment and labor, to a $63,000 average income. And by the way, that includes service jobs and so forth. If you actually just take gas and oil jobs, that number is even higher than that per capita. So much higher than the national average. The weekly wage is about $1,500 a week. If you took the average, the unemployment rate is 1.8%. Cindy Sanford, one of my friends who is the director of job services for Williston, she gives me all the stats on what's happening with employment. And right now we have, in the 4 core counties, we have 1,700 active openings, but only 1,200 resumes to fill those openings. So a 0.7 active resume per job opening ratio there.